a gym teacher from small-town Mississippi, built one of the largest telecom companies in America, then orchestrated the biggest accounting fraud the country had ever seen. Bernie Ebbers took a tiny company called Long Distance Discount Services and, through more than 60 acquisitions in a single decade, transformed it into WorldCom, a telecommunications giant. In 1998, WorldCom acquired MCI Communications in a deal worth $40 billion, cementing its place as the second largest long-distance company in the entire United States. But by 1999, the telecom industry was slowing, and WorldCom's actual growth couldn't keep pace with the aggressive numbers Ebbers had promised Wall Street. Rather than report the shortfall, Chief Financial Officer Scott Sullivan began making accounting entries with no legitimate basis, reclassifying ordinary operating expenses as long-term capital investments. That single trick let WorldCom spread regular costs out over years instead of reporting them immediately, making the company appear far more profitable than it actually was. Internal auditor Cynthia Cooper grew suspicious and, working secretly, often late at night, began digging through the company's financial records without her superiors' knowledge or approval. Cooper knew the risk. Questioning the numbers meant potentially risking her entire career at a company where challenging leadership wasn't exactly encouraged, especially not by someone several levels below the executives she was quietly investigating. Cooper and her small team eventually uncovered the fraud themselves, tracing billions of dollars in expenses that had been improperly recorded as long-term assets, rather than the immediate operating costs they actually were. When Cooper's team confronted Chief Financial Officer Scott Sullivan directly about the accounting entries, his explanations reportedly grew increasingly vague and inconsistent, only deepening her suspicion that something was seriously wrong. When Cooper brought her findings to WorldCom's board of directors, the company had no choice but to go public with what she'd found, triggering a chain reaction that would ultimately doom the company. The Securities and Exchange Commission launched a formal investigation almost immediately. Sullivan was fired days later, and Ebbers, who had already resigned as CEO months earlier, found himself at the center of a growing scandal. In July 2002, WorldCom filed for Chapter 11 bankruptcy, at the time the largest bankruptcy filing in American corporate history, even larger than Enron's collapse just months earlier, with debts dwarfing its $104 billion in assets. Later investigation revealed the fraud was even larger than first believed. Nearly $74.5 billion in earnings had been misstated over just 2 years, a figure that stunned even seasoned financial investigators. For the year 2000 alone, WorldCom's originally claimed $7.6 billion profit was eventually restated as a $49.9 billion loss, one of the largest single accounting reversals in corporate history. The collapse wiped out more than $180 billion in investor value, destroying retirement savings for tens of thousands of ordinary WorldCom employees who had trusted the company with their futures. At trial, Sullivan testified against Ebbers directly, saying his former boss was obsessed with hitting financial targets and had personally directed the fraud despite Ebbers' insistence that he had no knowledge of the manipulated numbers. The case ultimately came down to Ebbers' word against Sullivan's. After more than a week of deliberation, the jury believed the cooperating former CFO over the company's founder and longtime CEO. In 2005, Ebbers was found guilty on 9 counts of conspiracy and securities fraud, sentenced to 25 years in federal prison, one of the harshest sentences ever handed down for white-collar crime. Sullivan received 5 years for his cooperation. Cynthia Cooper was later named one of Time magazine's Persons of the Year for her role exposing the fraud, credited with having the courage to investigate her own company's leadership at real personal risk. WorldCom eventually re-emerged as MCI, later acquired by Verizon in 2006. Its original name reduced to a permanent case study taught in business schools on the dangers of unchecked corporate pressure. Like Enron before it, WorldCom's collapse helped drive passage of the Sarbanes-Oxley Act, permanently reshaping how public companies report their finances and hold executives accountable. Bernie Ebbers died in 2020, a little over a month after an early release from prison due to declining health. Follow for more stories about the moments the numbers stopped adding up.